Economic uncertainty is something that every investor faces at some point, quite often actually. Whether it's higher than you expected inflation eroding purchasing power, the threat of a recession, or major global events, these challenges can make it hard to decide what to do with your money. But here's the good news: uncertainty doesn't have to mean panic. History shows that resilient markets and thoughtful strategies can turn tough times into golden opportunities. By focusing on the right approach, you can navigate these challenges and come out stronger, making uncertainty less of a disaster and more of a chance to realign and actually grow your investments. Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that will be discussed is intended for information and educational purposes only and should not be considered investment advice or investment recommendation. Whenever you invest, your capital is at risk. This video will explain how to navigate uncertain economic times and why dividend investing can provide both stability and growth. The key takeaway, as the famous saying goes, this too shall pass, and staying the course can pay off in the long run. What is economic uncertainty? Economic uncertainty refers to periods where the future of the economy is unclear. So in reality, that's pretty often. It can result from various factors such as rising inflation, elections and geopolitical instability, global pandemics, or just changes in the interest rates. During these times, markets often fluctuate wildly, and this spooks businesses and consumers. This uncertainty can lead to reduced spending, slower growth, and job losses. Recent events that could potentially cause economic uncertainty include the ongoing geopolitical tensions in Eastern Europe, concerns over rising global interest rates to combat inflation, and the potential impact of climate-related disruptions on key industries. Additionally, technological shifts like the rapid integration of AI could create uncertainties around job markets and industry dynamics. These factors remind us of the importance of staying prepared as investors. However, it is important to note that economic uncertainty is a natural part of the business cycle, and after every period of downturn, recovery follows. Recognizing this cycle is essential for investors as it helps prevent panic-driven decisions that could lead to unnecessary losses. Key strategies for investing during uncertainty. Investing during uncertain times does not mean avoiding the markets altogether. Instead, it means adapting your approach and focusing on strategies that minimize risk while allowing for potential growth. Below are 4 key principles to consider. First, diversify your portfolio. Diversification is one of the simplest ways to reduce risk. By spreading your investments across different industries, sectors, and geographic regions, you minimize the impact of any single investment or market performing poorly. For example, if the financial sector faces challenges but you have investments in renewable energy or consumer staples, those sectors could help balance your overall returns. Similarly, geographic diversification ensures that if one country's economy faces challenges, your investments in other regions could help offset those losses. A well-diversified portfolio includes exposure to a range of sectors and industries that react differently to economic changes, acting as a protective shield during periods of uncertainty. Second is to focus on quality investments. During turbulent times, prioritizing high-quality investments is crucial. Look for companies with strong fundamentals such as healthy balance sheets, consistent earnings, and established reputations. These businesses are more likely to weather economic storms and maintain their value over time. Dividend-paying stocks can often fall into this category. Companies that regularly pay dividends tend to be financially stable and committed to sharing profits with their shareholders. Investing in such companies can provide both steady income and a level of reassurance during market downturns. Third is to stay disciplined. Market volatility can tempt investors to make emotional decisions such as selling assets when prices drop or attempting to time the market. However, these actions often lead to losses. Instead, it's essential to stay disciplined and stick to your long-term investment plan. One effective method is dollar-cost averaging, where you invest a fixed amount of money at regular intervals, and this approach allows you to buy more shares when the prices are low and fewer shares when the prices are high, averaging out your overall cost over time. Then fourth is to maintain liquidity. Economic uncertainty can bring unexpected challenges such as job losses or rising living costs. Having liquid assets, either cash or investments that can easily be converted to cash, is important for financial security. This can include keeping an emergency fund or investing in money market funds that are easily accessible. Liquidity also allows you to take advantage of opportunities. During downturns, quality stocks may become undervalued, providing a chance to invest at a lower price and benefit from future growth. That being said, it is still crucial to stick to your strategy during these times. Staying disciplined and adhering to your investment plan ensures that you can take full advantage of these opportunities without being swayed by market panic or short-term noise. Crafting a resilient investment plan. To navigate economic uncertainty effectively, consider these actionable steps. Assess your risk tolerance. Determine how much risk you're comfortable with based on your financial goals and time horizon, then adjust your portfolio to align with this level of risk. Research stocks. If you're dividend investing specifically, then look for companies with stable or growing dividends. Focus on industries known for resilience, as these are more likely to come out positively on the other side of economic uncertainty. Reinvest dividends. If you don't need the income immediately, think about reinvesting your dividends to accelerate compounding growth. Use a trusted platform. Choosing the right platform is crucial for implementing a solid investment strategy, and that's where the sponsor of today's video comes in, XTB. With XTB's Invest account, you can gain access to over 3,600 stocks and ETFs across 14 global markets, including a wide range of dividend-paying companies. On the XTB app, you can also invest passively with investment plans, open a flexible stocks and shares ISA, and earn 4.7% interest on uninvested funds, which is correct at the time of making this video. The platform offers advanced tools such as detailed stock analysis, live market updates, and educational resources tailored to investors of all levels. Its user-friendly interface simplifies portfolio management, allowing you to reinvest dividends and monitor your financial goals effectively. Additionally, XTB's low transaction fees and commission-free investing on certain accounts make it an attractive choice for cost-conscious investors during uncertain times. If you want to try XTB for yourself, then there's a link to sign up in the description and pinned comment of this video. Capital at risk, the value of your investments may go up or down. Review your portfolio regularly. Ensure your investments remain diversified and aligned with your goals. Rebalance if necessary to maintain your desired asset allocation. Stay informed. Keep up with economic trends and market news, but avoid overreacting to short-term fluctuations. Rely on your long-term strategy to guide decisions. Why dividend investing can be ideal during uncertainty. Dividend investing involves purchasing shares of companies that regularly pay dividends. These dividends are a portion of the company's profits distributed to shareholders, usually on a quarterly basis, but can be biannually or even monthly, depending on the company. Here are 3 reasons why I think this approach is particularly effective during uncertain times. The first is income stability. One of the main benefits of dividend investing is the consistent income it provides. Even if stock prices fluctuate, many companies maintain or even increase their dividend payments during economic downturns. This steady income stream can offer reassurance when other parts of your portfolio are underperforming. For example, utility companies and consumer staples businesses, those that produce everyday essentials like food and household products, often have a history of reliable dividend payments. These industries tend to be less affected by economic swings because their products remain in demand regardless of the broader economy. In fact, during times of economic turmoil, these types of stocks can sometimes perform even better as investors flock to stable, income-generating assets. For example, during the 2008 financial crisis, while many sectors saw massive declines, consumer staples and utility stocks generally held up better because their products remained essential, regardless of economic conditions. This demonstrates their resilience and highlights how such stocks can serve as a safe haven in uncertain markets. Second is the resilience of dividend-paying companies. Dividend-paying companies are often well established already and financially strong. These businesses have demonstrated their ability to generate consistent profits over time, making them more likely to endure economic downturns. By investing in these companies, you reduce the likelihood of large losses. Additionally, companies with a track record of increasing their dividends annually, known as dividend aristocrats, are particularly attractive. These firms have shown a commitment to rewarding shareholders even during challenging periods. Third is compounding growth. Dividend reinvestment is a powerful tool for building wealth. When you use your dividends to purchase additional shares, you increase your holdings without adding new money. Over time, this creates a compounding effect as you earn dividends on an ever-growing number of shares. Another advantage of dividend investing is that the income remains steady regardless of the share price. For example, if a company pays a fixed annual dividend of £2 per share, you'll continue to receive that amount even if the share price falls from £50 to £40. This steady income provides stability during market downturns. Additionally, if you reinvest these dividends when share prices are lower, you can purchase more shares with the same dividend income. So for instance, if your £100 dividend could previously buy 2 shares at £50 each, a drop in the share price to £40 allows you now to buy 2.5 shares instead. And this strategy accelerates compounding growth and positions your portfolio for greater gains when the markets recover. Suppose you own shares in a company that pays over 4% annual dividend and reinvest those payments when the share price has temporarily dropped. In that case, you increase your holdings more effectively than during periods of high prices. And over time, this approach can significantly enhance your overall returns. Lessons from history. History provides valuable lessons for investors facing economic uncertainty. Major crises such as the 2008 financial crash and the COVID-19 pandemic caused significant market declines, but recovery followed in both cases. Those who stayed invested during these downturns often saw substantial gains when markets rebounded. For instance, during the 2008 crisis, many investors sold their assets in a panic as stock prices plummeted. However, those who held on to their investments, or even added to them, benefited from the subsequent bull market, which lasted for over a decade. This demonstrates the importance of maintaining a long-term perspective. Conclusion. This too will pass. Economic uncertainty is just a natural part of the market cycle. While it can be uncomfortable, it also presents opportunities for disciplined investors. By diversifying your portfolio, focusing on quality investments and leveraging the power of dividend stocks, you can weather the storm and position yourself for future success. Remember, history shows that markets tend to recover over time, so staying patient and sticking to your plan is often the best course of action. As the saying goes, this too shall pass. With the right strategies, you can navigate uncertainty with confidence and emerge stronger on the other side. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!